Welcome back, YouTubers. So in this video, I'm going to give you an overview of index funds and analyze whether we should be playing the high school game of FTSE with the number 100 or diving into the world of S&P, which kind of also sounds like it came from 50 Shades of Grey. So what is an index fund? An index fund lets you easily, at a low cost, invest in multiple stocks that make up a stock index. So the question you're probably asking is, what is a stock index? An index is a set of stocks with some common feature that are grouped together and are used to analyze how a particular market is performing. For example, S&P Global Oil and Gas consists of 120 of the largest publicly traded oil and gas companies in the world. So when viewing the S&P Global Oil and Gas Index, you as an investor can get an idea of how the energy industry is actually performing. So index funds are probably the best way to get started in the stock market, purely because there are people in the background doing all the hard work and research for you. But when you get better at investing, they start to become less desirable, as you end up becoming more able to predict and understand the trends in the market. So, what kind of index funds are actually available? In the UK, the top index fund hasn't actually got anything to do with the high school game FTSE, but it is called the FTSE 100, because it is an acronym of the Financial Times Stock Exchange. And basically, it is made up of 100 of the highest value publicly traded companies in the UK. Now, you must be thinking, or if you're not thinking this, you should be thinking it. So, don't the value of companies fluctuate and the share price changes? Well, yeah, you're right. Which also means that the companies in the index also change too. So, who is actually in charge of changing this? Well, with the FTSE 100, the firm that owns the index is the London Stock Exchange. And every 3 months, they basically review the index and move companies in and out of it. Now, last year, you may have seen on the news that Marks & Spencer's, the huge, terrible Donald Trump impression, but yeah, Marks & Spencer's, one of the UK's largest high street retailers, dropped out of the index. So what is the FTSE 100 actually used for? It is used for creating futures and options. These are things you don't really need to spend time on understanding at this time of your investing journey. But what is important is the other way it is used. The FTSE 100 is regularly used as a benchmark for investors to decide how successful their investments have been. For example, if the FTSE 100 increased in value by 10% in the last year, then if an investor who has created a portfolio of comparable stocks was able to increase their portfolio value by more than 10%, then they could be dubbed as the luckiest guy of the year. Or maybe they are just really good at investing. The FTSE 100 is also a really good indicator of how well the economy is actually doing. For instance, if the value of the top 100 companies in the UK is declining, it's pretty safe to say that the UK is in trouble, which is pretty much what's happened over the last few months with this whole corona pandemic. Now, you can't actually buy shares in an index like the FTSE 100, as it's only a collection of data. However, you can invest in things called ETFs, which are exchange-traded funds. ETFs are basically a company that uses the money you have invested in them to then go and invest in all the stocks within that index. Now, the benefit of this is that you yourself don't have to go and spend that money required in order to buy equal shares in all those top 100 companies. But you can invest indirectly by putting a little bit of money into a fund that will be pooled with money from lots of people in order to invest in those 100 top companies. There are two main FTSE 100 ETFs that can be found on apps like Freetrade and Trading 212. Now don't forget to check the link below in the description to get a free share worth up to £200 if you don't use these apps already. Now there's also a video I made on Freetrade as well. So two main ETFs are iShares Core FTSE100 and Vanguard FTSE100. Now, before buying these ETFs, you should always check the annual cost. Now, iShares charges 0.07%, where Vanguard charges 0.09%. Either way, they're both below 0.01%. The other thing to consider is a return on investment. But index funds are always best to be looked at as a long-term investment. Because as you can see with the figures on the screen, which is showing the percentage gain and loss by investing in the FTSE 100 within iShares and Vanguard over the last few years. You can see it's been going up and down. However, we can also see that if you had bought iShares FTSE 100 ETF 10 years ago, you would have seen 51.92% increase in your investment. Now we can also see that Vanguard achieved similar results. However, Vanguard only created their ETF 8 years ago, so we don't have that value for the 10-year return on investment. Now, we also know that the dividend yield is about 5.9%. This means, as well as the change in market value of the stocks, you will also gain a dividend yield of 5.9%. This is where companies basically pay out a percentage of their profits directly to you as a shareholder. Now, at this point, it is probably going to be important to understand compounding. What is compounding? Compounding is essentially the method of reinvesting profits in order to grow your investment at a higher rate. For instance, if you were to put £500 of cash under your mattress every month, you will end up having a linear growth. And then after about 10 years, you will only have saved about £60,000. However, if you were to put £500 a month into the stock market with a dividend yield of 5% and reinvest that return, you will then end up saving £79,240 pounds, which is an increase of almost £20,000 over the same time period. Now, taking into consideration, over the last 10 years, the FTSE 100 has had an average compound return of 8.8% per year. This therefore meant that it provided a return that was 121%. Now that makes it a pretty safe and desirable investment. Now, there are obviously lots of other ETFs to look at. Some of the top ones include the S&P 500. This tracks the stocks of 500 large cap US companies. Then we have the Dow Jones Index, or is it the Dow Jones Index? Basically it's spelled like that. And this index is a stock market index that measures the performance of 30 large companies listed on the stock exchange in the US. It is one of the most commonly followed indexes. However, many people now consider it to be an inadequate representation of the overall US stock market, and so they prefer to use the S&P 500. Then we also have the Nasdaq Composite Index, which is the market capitalization weighted index of over 2,500 common equities listed on the Nasdaq stock exchange. We then also have the Nikkei 225, which tracks the top 225 blue chip companies listed on the Tokyo Stock Exchange. But now, the all-important question, what should I invest in? Personally, being a novice investor, I would have it down between the FTSE 100 and the S&P 500. Now, the FTSE 100 provides better dividend yields. However, since the last financial crisis that ended in 2009, the S&P 500 actually quadrupled in value, whereas the FTSE 100 only doubled in the same period. Now, even taking into consideration the higher dividend yield that you were getting from the FTSE 100, the S&P 500 still overperformed the FTSE 100. Now, regardless, the S&P 500 seems to be a little overvalued currently. Therefore, in a normal world without this coronavirus, I would probably lean more towards the FTSE 100 as being a more safer bet, taking into consideration the full history of the markets. But the S&P 500 seems to have done so well recently due to a lot of tech companies gaining a high value very quickly. Now, with the current day and age, I don't really see that changing much. So I do feel like tech companies are still going to be doing really well. Therefore, during this kind of Sports Direct closing down stock market sale that we're currently having, I will be splitting my savings in both the FTSE 100 and the S&P 500 and ride the Rona wave to see what gains I can make from this. As always, this is obviously just my opinion and I don't have any financial investment background, so I suggest that you also do your own due diligence and research before making any investments. But I hope this video has helped you understand some aspects of index funds, ETFs, the FTSE 100, a little bit on the S&P 500, and I hope it's gained some value to you. Now, if you liked the video, or even if you didn't, don't forget to subscribe and hit the bell button so you can get notified when my next video comes up. And always feel free to like, share, and comment. See you at the next video.